we're in a world where this is more available than ever. And a lot of it has to do with what are you reading about? Some people are great with technology. Others are great with finance. Some people are great with, you know, some crazy nuanced thing that they understand something around health and what that's going to mean. So it's about really figuring that arena out and then understanding how you can invest in that particular area.
The investment index. See, there's a tool that we use called the cash flow index to determine which loans to make priority and which ones to pay off, attacking only one at a time with extra cash. And the cash flow index just takes the loan balance, it divides it by the minimum monthly payment, it spits out a number. And really, if that number is less than 50, the banks love you. Because what it means is they don't have a lot of their capital at risk that they've lent you, yet they're getting a relatively high payment. They're in the business of cash flow. They're cash flow investors. When you go make a deposit, they don't go put that in some retirement plan waiting for 30 years. They're not following that methodology of money times rate times time. They're really focusing on velocity. They're focusing on cash flow. They want to see how can they create something called arbitrage. Arbitrage simply says if they can get you to give them $1 and they can pay you, 2 cents to rent that $1 and then go sell that $1 for 4 cents, as far as interest payments, then they're cash flowing. So if they're charging 2%, that's a really low interest rate, but they're only giving you 1%, that's 100% markup. That's an amazing situation for them. That's a great return. How easy is it to get 100% returns? Well, that's almost non-existent out there in the world, but institutions are doing that all the time. You can walk into any institution right now. You'll see, they'll say, here's the savings rate, here's the money market rates, here's what we pay on a checking account if you have enough money in there, right? A lot of times that's 0%. Then on the other side, they'll say, here's our car loans, here's our mortgages, here's our signature loans. And you're going to see those are double, triple, maybe even quadruple what they're charging versus what they're giving. They don't have a product, they're just intermediaries with money. So as we learn about the investment index, it's going to help you understand. If you're going to achieve economic independence, which is creating enough cash flow on a regular basis, coming in from your assets, or coming in from entrepreneurial-based income, which is income that shows up even if you don't, meaning you don't have to go to an office or open a laptop and money still comes in. You're still going to monitor that. You still have to manage it for it to happen. But economic independence is having enough of that recurring revenue to cover your basic expenses. Well, are you going to get there faster by paying something off, or by becoming a better investor or the investor you already are? So we're going to compare the cash flow index to the investment index. The investment index is more what the banks look at. When they've lent you money, they want to see what the investment index is. They're taking what money that they put out there, then they're dividing that by the cash flow that comes in, and they want that number to be as low as possible, right? You want a high cash flow index, you want a low investment index, because we're looking at two different parties. Cash flow index is the borrower, investment index is the lender. So the investment index, low number means they're getting good cash flow for what's out there. Cash flow index means a low number, you got not that much money and you have to make a high payment. So let's talk about this in really simple terminology. Tim, I think I'm going to hurt myself, or I did hurt myself, carding with me today. A great money nerd, someone that really knows this inside and out. So, I kind of had an epiphany once. When I was teaching this at a wealth acceleration workshop at Wealth Factory, before we even had investment indexes in the workbook, I wrote them up on the whiteboard and I was like, let's just look at this from the other side. When you're putting money in a retirement plan, when you're putting money into real estate, when you're putting money into your business, I said, how much is that money paying off? And they found some had no index, just zero, had zero cash flow. It wasn't helping them achieve economic independence. Others were 150. It was like they weren't getting much cash for the capital they put out there, yet at the same time, the money they had borrowed had really high payments. Yep. So for them, just paying things off meant a lot more than actually investing.
Exactly, and when you first taught this to me, my dad was one of my best success stories for finance in my life because it was my dad and it was hard to work with him. But Stubborn, right? Which my wife claims I inherited that. I don't agree. And I
love the irony there.
I know, right? And so we look at that. When I went down and said, hey, okay, let's look at all your cash flow indexes and where all your equity positions are and how much you're earning from those positions. And now let's look at your investment index for your equity positions, your cash flow index for your loan positions. We just started swapping the two. We made an immediate $3,500 a month difference in his life positive.
By paying things off versus trying to invest in things that weren't kicking off cash flow.
Exactly. Using the investment indexes that weren't giving any cash flow and paying off loans that had high cash flow cost. It made an immediate $3,500 a month difference for him.
So here's how you determine your investment index. how much money did you put into the investment? Not what it's worth. How much capital did you allocate divided by how much cash flow is coming in on a monthly basis? Now, if it's only coming in quarterly, you'll have to divide that by 3. If it's not coming in at all, you know, it's simple math. We could take anything times 0, and it's always 0. So we don't have to worry about it if it's not getting any cash flow. You know that you're not in the best position to create economic independence. And economic independence is the ultimate win then play. When you're economically independent, enough cash flow coming in to cover your life's basic expenses, it means every active dollar you earn can go be reinvested, can improve your quality of life. You get to be fully free in choosing what to do with that. And it can really stabilize relationships if you have a significant other. A lot of times people marry someone with a different money personality. One person's a spender, the other person's a saver. There's some weird, I don't know, diabolical law of attraction in there where we find that interesting, even though it's kind of insane, right? Or maybe one person's a giver and the other person is an avoider. And avoiders don't want to think about money or look at it. They're probably not watching this video right now. If they do, congratulations, right? On the other hand, if we really compare that, you'll see there's a lot of contention. But if you're economically independent, there's like this lack of compromise, but amazing platform for people to get along better. Rather than having one person be the gas and the other one the brakes, it's like, hey, we now know that we'll be able to eat the same types of food, go to the same types of places, live in the same type of home, give the kids the same type of schooling, whatever it is, that's now taken care of from your assets and your cash flow. You have full permission to swing for the fences and other things, to be able to be speculative if you choose to be with a little bit of your investing, because you're not putting your family in harm's way. Now the investment index, what investments have you made? How much have you put into those divided by the cash flow that's coming in? And if that number is really high and your cash flow indexes are really low, which are your loan balances divided by the minimum monthly payments, it's time to pay loans off rather than invest. If the opposite is true, we have really high cash flow indexes and really low investment indexes, a low investment index, once again, is a huge positive thing for you. Well, it's time to invest your way to economic independence rather than paying those things off. So this really, once again, comes down to it depends on the person. Personal finance needs to be personal.
Absolutely. And the financial institutions have done a great job on getting you to invest in their purpose and not your own purpose.
Right. They're good at the investment index.
Exactly.
They're great at it.
We had a banker, he was a secondary investment advisor for bankers, right? So he came up at the montage after my segment and he said, hey, look, what you explained is exactly what I do for a living. He goes in and looks at entire portfolios, loan portfolios of banks, and he says, how much did we lend and how much cash flow are we getting, right?
Right.
What is our investment index? The higher or the lower the investment index is for them, the better they're able to get additional lending capability, right? They're a stronger bank, so they're able to do more and more of that fractionalized lendings. Yep. Or they can now package that debt and sell it off in derivatives at a much higher price point, so they're churning those loans.
Right. See, the money nerd, he's talking derivatives, he's talking, just bundling loan packages. So essentially, let me break this down. If you've gotten a loan, if you've ever gotten a mortgage, let's think about that process for a minute. I refinanced my house last year. So what that meant was we had to look at our taxes for the last 3 years. We had to pay for an appraiser to come in and appraise the home. We had to make sure that there was enough equity in there so that we didn't have to pay private mortgage insurance, which means 80%, if it's above 80%, then we'd have an insurance that we have to pay that protects the banks. So think of all the things that the banks are doing to mitigate their risk. And when they do a good job at managing that risk, they're very sustainable. In 2008, 2009, 2010, they started saying before that, oh, yeah, just tell us your income. We won't have to look at it. That's called the stated income loan. Should be called the stated lie loan, right? Or they'd say, oh, we could do a negative amortization loan, which meant that you don't even have to make the full interest payment. It starts to get tacked on to the balance, and that can go up to 125%. So they're doing all these kind of things in the past that got them into trouble. Now, when they are being more strict about who they lend their money to, they're really lending to the individual, and then they're backing it up with collateral. They've got the collateral of the property. They're looking at the appraisal and make sure it's worth enough based upon the other comparables. They're making sure there's enough down payment so that you're not likely just to walk away if you have no skin in the game. And if you don't make enough down payment or you get a second mortgage, they might even charge you a higher interest rate for the second mortgage. Or if you don't get the second mortgage, they might charge you private mortgage insurance. These are all things to help them out. Now, here's some of the tricks that they do. If you'll do a shorter loan, they'll give you an interest rate break. Why is that? Because a shorter loan improves the investment index for them. They're getting more cash flow. And they know most people refinance their home and they don't stay there for 15 years. It's rare for someone to get into a home, pay every single payment, and pay off a 15-year mortgage. They typically relocate or they refinance. And so ultimately, they're looking at the most cash flow because that lowers their risk. More cash flow, more principal, the more equity, the more that if something goes wrong, they have an asset they can liquidate and get their money back. If you've borrowed every dollar that there is to borrow, the market goes down and you default, they're not good at real estate. If you ever heard of REOs, where that's bank-owned property, they're typically selling those portfolios for pennies on the dollar. So their investment indexes, they're a cash flow machine. They're protecting the downside. They're looking at ways that they can get cash flow. They're not locking money up for 30 years. They're not hoping that it's going to work out. They're instead calculating their risk, minimizing it, and creating that cash flow.
I'm working with a dentist right now who we're going to refinance all of his business loans because it's going to free up like $3,000 or $4,000 a month in cash flow. The bank is fighting him on that, and their excuse is, well, this one part of that, one of those loans in that package, you're going to go from a 4% interest rate to a 5% interest rate. So they're trying to act like they're looking out for his bottom line. But really, they're denying that loan solely because they're going to get less cash flow for the amount of money that's collateralized.
And think about it, it can make sense to go from 4% to 5% if your cost of money, which is your best sustainable rate of return that you can get, or your highest cost loan, right? If your cost of money is higher than 5%, where you can earn more than 5%, or you have a 20% increase on one loan, but you have decreases on other loans, we have to look at the big picture, not just in a vacuum. So the investment index, this is a little bit more difficult concept to really understand, like, how do you get a low investment index, which means high cash flow in relationship to a low amount of capital allocation. That's what you're looking, how much did you put in versus how much you get back. You want that number to be low, just like the bank does. Cash flow index, that's when you borrowed money. You want that number to be high because it means you got a lot of money in, but you're not having to make as big of a payment, which gives you more control of your cash flows, more of a path towards economic independence. And look, we're gonna continue to unveil these money matters so that you can be more versed. Hopefully we demystify the complex world of finance for you so that you can be in control of your finances, take that back, improve your financial situation, and be more empowered. There's a couple factors with investments. One factor is there's a lot of unnecessary fees, hidden commissions, and it creates massive drag on people's finances. And the thing is, because it sounds like a small percentage, we discount it. So let's have an example. If you had $100,000 and you could actually earn 10% for 30 years, because isn't that what we hear, that the stock market's averaged 10% since 2000 BC? Or some, yeah, at least, yeah, those days were always gone. It actually never existed because averages are a lie. Like if I had 2 shower heads this morning and I turn one freezing cold and the other one scalding hot and I step in, on average it's a lukewarm temperature, but in reality I'm miserable as hell, right? Like, because here's an example. Let's say that you have let me just show why averages don't tell the truth. If you have 100 grand and you lose 10%, it becomes 90 grand, right? Now, what if you turn on CNBC, which when Angelique said I was on CNBC, that was a one-time thing because I got kicked off, and I don't think they're gonna have me back because when you say not to invest in the stock market, they just cut to commercial, and the commercial is about the stock market, and the feed is dead. There was no one, it was just quiet, and I was like, hello? And then it was over, so. They could have watched anything from me, and I just am who I am. You're going to get it every time. So now they say, oh, it's rallied. Things are amazing. Now you earn 10%. What are you at? 99,000. Now that's assuming they were nice and they didn't take any fees. But guess what? They take their fees whether it's up or down. So now you have fees, plus you lost 2 years of gains. So now you're so far off. So check this out. Let's say you had $100,000, you earn 10% for the next 30 years, it grows to $1.74 million. But what if you had to pay a 0.8% fee? Less than 1%, right? It only grows to 1.4 million. Because it's exponential. Compound interest also has a correlating compounded cost. I mean, I remember in school they would teach about compound interest. Like, if you had a penny and you doubled it every day, how soon you'd have more money than the entire world has combined. I'm like, but if you took the taxes out, it would take forever for that to actually start doing something. That's why we look at efficiency first. So on the investment side, we want to find out, is there any headwind? Is there any drag? But here's the biggest mistake in the world of investing, is not protecting the downside. Far too many people participate in the downside because rookie investors always stay invested. The pros act a lot more like predators, and I don't like that necessarily, that word, but Malcolm Gladwell wrote that about Ted Turner. He said Ted Turner stayed in cash like crazy, and then when the market went down, that's when he bought everything. When McDonald's grew so big, they bought tons of real estate during market downturns. Burger King decided to scrimp and get into recessionary mindsets, which led to less production. But I'll tell you what, when times are tough, that's when the most millionaires get born, because people want leadership. Because the bigger the problem, the bigger the payoff for people that are willing to embrace it, because everything relates to value creation. And dollars follow value, so when do people need value? When times are perfect and nothing seems to be a problem, or when times seem to be collapsing around them? So I want you to be in such a financial situation that you can capitalize on opportunities and not be stuck in investments that are mediocre just in the name of some retirement. And if you are in investments, at least having something called a trailing stop loss. At what point when the market goes down does your mindset follow it? You're your greatest asset. And if all of a sudden you can't produce as much because of a financial asset, you're going to make less money. So create a trailing stop loss. It doesn't cost anything. Your advisors just might not tell you about it because they don't get paid when you're in cash. Hence why most business owners are grossly underfunded with their liquidity. They don't have enough savings. And savings is part of your protection. Savings is part of your peace of mind, right? Have you ever, I know, maybe I'm the only one that did this, but in 2008, I overextended myself a little bit, had a whole bunch of real estate, decided I want to take my book to the New York Times, had a kid. There's a lot going on, and the economy's kind of changing, and all of a sudden, for the first year, I had a down, and I didn't have the cash flow that I was used to, so I took on bad profits. Bad profits are pain in the ass customers. People that I knew I didn't want to work with, but I took on anyway because I wasn't in a good financial position. So now I make sure to have at least 2 years liquidity at all times. Now that may seem like a lot as far as getting there, but realize that I've got a 40% advantage over most people because I pay so much less in tax, so much less in interest, so much less in fees, and all the things that I'm about to teach you. So now that we have the framework of the 4 I's, that's the efficiency game. IRS, interest, investments, and insurance. Let's get into the taxes. I'm going to have stuff that you can put on the ground and implement by Monday.
I inherited money, a few $100,000. I would like to put it to good use by either buying or starting a business.
This is really throwing you off, huh?
It kind of is. I don't want to squander or lose it. I don't know any entrepreneurs or anyone that can give direction on how to build cash flow without having a regular job. Before this money, all I knew to do was save, save, save. I've taken the time to educate myself on economics and the stock market, but worry about taking the wrong advice. How can I find a mentor? I'm in the Phoenix area, and start creating cash flow.
Okay, first off, we have a program at wealthfactory.com/scale, SCALE. Okay. That is great for, like, if you're going to acquire businesses and how to manage those businesses. We got our CMO, Matt Silverstein. We got our chairman, Norm Westervelt. I take people through it, Brandon Allen, our business scale strategist. So it's a pretty great program. I think that'd be helpful. But let's start with Investor DNA. Go ahead and tell her what Investor DNA is.
Oh, I'm the money nerd now.
Yeah, you know.
I do. Yeah, Investor DNA is knowing your skill sets and what you're able, what you're an expert in, you know, and where you can really focus your energy and be successful, and not relinquishing control over to someone else. Like, really own your power and add value into the world in that way. Yeah,
invest in what you know, right? So well said, Stova. Basically, risk isn't in the investment, it's in you, the investor. So what kind of investments are you going to do? Some people are good at real estate, others suck. Some people are good at the stock market, not many. Most people suck at it, right? Some people are good at tax liens, others aren't. Like, some people are good at acquiring businesses and understand the fundamentals, others aren't. So if you don't have an answer, the first place you invest a portion of this money is getting educated. So yes, part of that is finding the right person that you could learn from. Then secondarily, which I think she understood, is building a network of people and professionals. We're actually doing that at Wealth Factory right now. We're interviewing all these business acquisition specialists, these business exit specialists, that this is what they've done for their career, to build a network just for this very thing. And that's why wealthfactory.com/scale. So that's my first answer, is figure out what kind of investor you're going to be, and focus instead of diversify. Where are you going to put your time and attention so that you can create risk management and strategies to understand what's really happening?
So when someone's starting out and they're trying to figure out their investor DNA, let's say they've never had an investment. They never have owned a business. They've never put money in the stock market. How do you even figure out what you're good at, without spending a ton of money or losing time?
Yeah, well, what's nice is there's a lot of like inexpensive courses right now. There's books, there's audiobooks. Like you could just see, like, do you have a natural inclination towards these types of things? Like I've been doing a lot of webinars and podcasts. I just did one for Nate Lynn's group, which they're all about business acquisition for digital businesses, right?
Yeah.
Like e-commerce type businesses. I've spoken at amazing.com before, which is all started out as how to build a business on Amazon, and people are, starting a business with less than $5,000 and becoming extraordinarily profitable. So we're in a world where this is more available than ever. And a lot of it has to do with, what are you reading about? Some people are great with technology. Others are great with finance. Some people are great with, some crazy nuanced thing that they understand something around health and what that's going to mean. So it's about really figuring that arena out and then understanding how you can invest in that particular area. So, I mean, that's the big piece. So a lot of this is also being patient. Don't jump into investment too quickly. Look at a lot of investments before doing something. And if you could find someone that you can add value to so that you could learn from them at the same time, you're giving them your time and your whatever ability you happen to have, so that you can see how it's actually done, how these transactions actually occur. Yeah. I know a lot of people that do that in real estate, right? So there's so much in this world. I like the book Buy Then Build by Walker Dybo.
Yep.
Especially for business acquisition and entrepreneurship acquisition, where you're looking at smaller businesses, and with the kind of money that she has, that's, easy to get a decent sized business. Like 96% of businesses don't even crack $1 million of revenue. So you could be buying a business that for the amount of money that we're talking about here, and start cash flowing that from early on. But you better understand basic fundamentals about business, and, just how you can manage cash flow. And, in Win Then Play, one of my books, I talk about these 7 factors of business. The first one is just having basic reports where you understand, okay, what are the 4 things that drive the most value for this business? And if you can measure that, then second, have you looked at the margins? Is there anything that can be improved? Is there something that needs to be dropped because it's not profitable enough or doesn't make sense? Is there something where you survey your clients and they say, hey, this is something we really want to do, and you either have a strategic partnership where you can actually add another line of revenue, or you build that yourself. Like, I could go on kind of forever on this topic, but what I look at is the cycle of creation. And the cycle of creation is we begin with an idea, right? And this idea is, hey, maybe I should buy a business. Great. To make that a concept, it really takes investing and understanding what type of business, narrowing that down, and then really figuring out, someone that's already in that industry where you could go learn from them and work for them, or anything that way. And then you can start building your framework of, like, what's your process for that purchasing, and how do you make sure that it's going to be profitable, and, those numbers that we're talking about. And then what can you do to add more value to that existing business that it's not seeing right now because that business owner was tired or struggling or just ready to retire and hadn't really put any energy into it? Yeah.
One of the things that I want to add to Investor DNA is sometimes I think a good initial place to start is to stop and think about where your headspace is. Like, when your mind wanders, what is it wandering to? What are you thinking about? What do you want to read about? What do you gravitate towards when you research? What kind of conversations do you like to have? And that can be a good stepping stone into engaging into what is my investor DNA and where do I even start? Because there's so many possibilities. And if you're like me, I'm just like, the world is such a beautiful place and there's so many things that are fascinating. I could do any of these and be happy. But maybe just think about, I would encourage you, Nicole, just to focus on where your attention goes.
Yeah. I like how you're saying that, because this is like, I think we make it too complex sometimes and we want to have it all figured out from day one. But it's like, just look at the footprints of attention in your life. Like, what are you reading normally? What are you studying normally? What do you find fascinating? Where do you figure things out quicker than someone else? And I think some like self-reflection is helpful. We like the Kolbe profile, Kolbe, which tells you your conation, how you like to get things done. I know you've studied the Enneagram pretty extensively, Enneagram. And I think that's super profound. So like, have an understanding of how you operate so you can team up with people that operate a little bit differently or can fill in the gaps where you don't have that. And I mean, I think business acquisition is going to be a huge opportunity for the next few years. There's going to be a lot of businesses that don't make it that you could buy for very inexpensive, or there's going to be people that are just retiring and they're going to want to sell. And so I think the next 2-3 years, that's the place to go.
We've got a question from Timothy. He's a 53-year-old employee with $100 left over each week. So if he's lucky, he says, and $49,000 in an IRA, he can't touch without getting hit for 30%. He's wondering what he can do to turn the crappy life around. I'll give him some advice maybe on production if you can give him advice on the investing side. He's looking to turn his 15-year mortgage into 30-year so that he can get about $11,000 out to pay off 3 credit cards, which I think that could be a great idea because credit card interest is going to be a lot higher than mortgage interest. You just got to be a little bit careful not to go spend that extra cash flow, right? You got to make sure to save that, and that's going to boost that $100 that's left over. He's hoping out about $200 per week doing just that, which is awesome, right? And he's watched a lot of our videos, read a lot of articles. So what options does he have, Ryan, with his IRA? There's a 401k transferred over from a brokerage account from a past job, and he really can't touch it without penalty for 7 years. So you're the expert on this for sure. I'm glad we got you to answer this question.
Yeah. So what you should be doing with your IRA kind of depends on what you've got going on elsewhere. So it sounds like he may not have a ton of kind of the basic savings, just cash reserves, things that way, which tells me that money should probably be invested pretty conservatively, because in an emergency, you might access it despite the penalty and the tax consequences, especially if you don't have a cushion built up and just haven't taken care of the basics, kind of, built the foundation for your finances first. A lot of people get trapped into the 401k first model, where it's like really protect yourself first, then you go invest there. The way I describe it is you earn the right to invest by building your base.
So what do you think about a self-directed IRA? What do you think about a Roth IRA conversion? And does he have any options? Because he's got this big tax bill that would come with it and a penalty. What options does he have in those arenas, and what's your opinion?
Well, so the self-directed is used in kind of two different ways when you describe an IRA. So it sounds like you may already have a self-directed IRA, which means you choose how you invest the money. And you could do that at any one of numerous brokerage houses, where you choose whether you're going to buy certain stocks or certain bonds or funds or things that way. That's self-directed. Well, the other self-directed that people talk about is, well, what about alternative assets? And how can I own those? And that's something you can do, but there's particular companies that are not your typical brokerage houses that do that type of thing. The trap I see people fall into there is they get to the point, and it sounds like Timothy is at this point a little bit, where it's like, hey, I'm getting close to retirement. I feel like I'm behind. How do I make more money? Well, then they end up chasing a rate of return, getting into private investments that promise great rates of return, and then the next recession happens and your money went to zero.
A lot of the private investments don't have the type of market to liquidate that other traditional investments might have. So they might be tied up for a long period of time. You might be dealing with more amateur level investors with some private investments. It might be a new venture for them, and a lot of the startups don't work. So something to definitely be cautious of. With the $11,000 on credit cards, is there really any way that he could access the IRA to pay off those credit cards, or would he just be simply facing a penalty and paying the tax?
I mean, there are certain ways to access a portion of that, but unless it's a really large amount of money in an IRA, it's not worth the administrative headache.
Right, because what's that one provision that's mainly used in divorce that lets people avoid the penalty, but it would cost half of what he's paying off in his credit cards to even consider, right?
Yeah, exactly. Yeah, so there's a couple loopholes there. One's in divorce. There's a 72T, which is basically an early retirement election. There's some things that way, but it's not like these are
not worth it.
Not typically worth it, and administratively heavy. So it's like, yeah, you can do these things, but plan on getting a letter from the IRS in 3 years, and plan on having your CPA need to respond to that, even if it's legitimate. And it's like, well, now you just cost yourself $800 in fees to your CPA. Did you at least save that? On the other side.
And on the Roth conversion, advantages, disadvantages, what's your opinion about that?
So the Roth conversion, basically, you're going to pay tax, but if you access the money before 5 years or 59 and a half, whichever is greater, the whole 10% penalty is going to come back on the whole amount. Whereas in a normal Roth, the penalty is just on your gains. Well, if it's a Roth conversion and then you access it, they're going to treat it like it was the traditional IRA.
And if you pay taxes from inside of the IRA, is that penalized on the conversion?
Correct, because you're going to have to take a withdrawal out of a traditional IRA to pay the taxes, and then that's penalized in tax. If you're
so he couldn't really move to a Roth and pay off the credit card, because if he moved to a Roth, he'd probably have to use the money off the refinance to pay for it. So that's not necessarily a good option. I mean, I like that he's considering refinancing. And I think a lot of people, Ryan, are probably scared about going from a 15-year to a 30-year because they go, well, now you're going to pay so much more interest. But we always have an interest cost, whether we pay cash and forfeit the right to earn interest or whether we pay the bank interest. Most people only think about what they're paying the bank. And so, yes, there's a risk by lengthening that loan because, you know, basically if Timothy were to go out there and spend the money, then that is all for nothing. And he's got this longer period that he's paying those credit cards, even though at a lower interest rate. So, you know, this will get him ahead of $100 each week. It'll add another $200 per week. And Timothy, for you, maybe even consider, like, is there a side hustle? Is there a, you know, so many people right now have like 1099 income because they offer things or do things. The simplest of those being like Turo, where they rent out their car, or Airbnb, where they rent out a room in their house, to driving for Uber or Lyft, you know, but then there's tons of, you know, companies out there for people that are graphic artists, or, you know, there's a number of those things. So if you could find a way to increase your income because there's more coming in, if you can invest that back in yourself and in your skill set, maybe there's a way to grow that spread further where there's more coming in. And then obviously you can look at cash flow banking. Ryan could speak to that. That might be a place to store some of this cash so that you are building up that cash so you're not stuck in the mortgage for 30 years. You have liquidity and access to money in case there's opportunities that come your way. And you've also just built up a bit of a peace of mind fund that isn't predicated upon what the stock market does. So the first thing I heard you say, Ryan, is you should be pretty conservative with the money inside of the IRA, considering the amount that we're talking about and everything else that's out there. A Roth conversion doesn't make a lot of sense. A 72T that lets you get the money out without penalty doesn't make a whole lot of sense. But building up savings and safety makes some sense. You know, finding a way to take this extra income and capture it somewhere like cash flow banking can make some sense. And then I'm saying, yeah, invest back into yourself. I mean, I feel like Timothy's on a pretty good track with some of these thoughts he has here.
Yeah, I agree. And yeah, the reason I talked about being conservative with his investments is it sounds like there's not a lot of liquid savings not in retirement accounts.
Right.
So that makes your retirement account your backup plan.
Yes, so the very first thing would be, let's get at least 3 months expenses on your personal side set aside in a savings account, just with that extra money that comes in per month. So set up a money market or a checking or savings account separate than your personal account. We call that a wealth capture account. Start automatically putting that extra cash after you refinance into that account. So you've got some safety measures and some contingency planning so that you don't have to go just rack those credit cards back up again.
Yeah. And I like to see that wealth account 1 degree separated from your day-to-day banking. So instead of like an emergency savings, which is a separate thing, being maybe a savings account at your bank where you already have your checking account, I like to see your wealth account somewhere else.
Yeah.
Whether that's an online bank, or I use a brokerage account for mine actually, but so it takes a deliberate decision to transfer the money and might take a couple days to access. So you don't make a rash decision and just drive a nicer car without thinking about it.
I asked a little bit more nuanced question to ChatGPT, which it was pretty generic without much depth or strategy. I said, now, how do you go about eradicating poverty and embracing abundance? So I'm adding this abundance concept, so it's not just about scrimping, saving, sacrificing, deferring, delaying, and working harder. It's not just about government programs. I thought, what about abundance? And it said it was a complex challenge that requires a multifaceted approach. No shit. Some potential strategies to address poverty include, 1, investing in education, very similar to what it said before. It said providing people with access to education and training that can help them acquire the skills and knowledge they need to find good jobs and improve their economic status. That's a better answer than the first answer it gave in this. It's saying to improve their skills or acquire skills and acquire knowledge. Before it just said to get an education. It said to improve their economic status. Well, the more value you can offer in the world, the more money that will be available to you. Now, maybe that's not totally true if you're working for a nonprofit, or you're working for the government as an educator, or you're working in a kind of a fixed industry. But if we're talking about in the private world, the more people you can impact, or the more deeply you can impact people, dollars follow that impact or that value. So that's my additional part here. It said promoting economic growth and development. Encouraging economic growth and development in countries with high levels of poverty can create job opportunities and increase incomes. That couldn't be more generic. Thanks, ChatGPT. You did nothing. You shouldn't lose all your sleep right now, people, on AI taking over the world. Now, maybe this will happen exponentially soon, but this is pretty rudimentary so far. Something a Google search could have got you anyway. It said number 3, reducing income inequality. Now, I agree with this. Income inequality can contribute to poverty, as those at the bottom of the income distribution may not have the same opportunities to improve their economic status as those at the top. Policies such as progressive taxation and targeted social welfare programs can help reduce income inequality. Oh, now we get to where I disagree. Policies such as progressive taxation and targeted social welfare programs can help to reduce income inequality. Look, here's why income inequality exists. Here's the reality. Quantitative easing. When we have the Fed printing trillions of dollars, when we have that money then going to banks and financial institutions and Wall Street rather than to education and helping people. So what happens is we start to create this unfair system where the system is rigged in the favor of the people that already have substantial amount of wealth. We say, oh, we'll give it to them and it'll help everyone else out. It doesn't. Or even when we just hand out money without any level of education or any level of responsibility, it might provide temporary solution to our woes and difficulties in a time of a pandemic, but ultimately can create reliance where people no longer look to themselves for the value in this world, that they're serving others and solving problems. They look to someone else doing it for them. And when we cry for that, we're actually saying, let's rob other people to redistribute to the others. Now, look, I want to help people that are at a disadvantage. I mean, I don't really make a lot of money doing this YouTube channel. I'm trying to get this message out there. I make more money doing one-on-one consulting. I make a lot more money, doing speaking. But this is part of how I contribute, how I write, how I create, and I enjoy it. But I don't want to be forced to do it. And then I have to do it. It takes away my personal freedom. It takes away my personal passion. It starts to feel constraining. And yet this is what happens oftentimes when we think, oh, let's just have this all go to social welfare programs and let's help a progressive taxation because the rich aren't paying taxes. That's not necessarily true. What's happening is if you're in poverty, you're not paying much in tax, but we have so many taxes out there. You have to pay to eat, to work, to live, to buy, to sell, and hell, even when you die. And that's not even mentioning the income tax that most people are talking about. So ultimately, we have to invest in humanity. But what it's not talking about, we have to have compassion for one another. We have to learn how to connect with one another. We have to look at what we have in common more than what we're divided in. We have to look to pay it forward. Like I'm doing a kids book because I'm like, let's impact the kids. I have a social mission where I'm giving to programs that help me, like Governor's Honors Academy and things like that. Like we have to allow people to make choices. And if we just believe that humanity is corrupt and evil and bad and wrong and no one will step up, then we want governments to come in and handle that. What if they're the same people that are bad and corrupt and wrong and everything? Then what we do is we look at reducing income inequality in the wrong ways. I'm here to tell you, fractionalized banking, quantitative easing, all the things in private banking have been more responsible for income inequality. All these crazy things that we've seen with big firms or big Wall Street managers and hedge managers and naked selling and short selling, those kind of things have been contributing more towards poverty and income inequality because now people are in desperate situations, trade their time for dollars, work 2 or 3 jobs, while someone else uses the philosophy of saying, hey, what if we control the money supply as the central bank? Do you understand that part of it is the process and the system and the structure and what happens here that is unfair because it's really only favoring people based upon a caste system or based upon where they're controlling and not telling everything that's going on, or where we don't have punishments for when Goldman Sachs does atrocities to places like Malaysia or humanity and nobody goes to jail. It's about responsibility and accountability. And it's about compassion and caring. That is how we reduce income inequality. And then we bring real skill sets in education, not just education that leaves people in debt $250,000 with a student loan. All right, not that I had any passion about that part. Not that I'm angry, but I'm just saying this is part of the issue here. Now, number 4, it says providing social safety nets. Safety net programs such as cash transfer programs and food assistance can help to alleviate poverty, providing a source of income and support for those in need. I don't need to really go into too much more because I addressed that in the previous point. Addressing systemic issues. Okay, that's point number 5. ChatGPT says poverty can also be caused by systemic issues. No shit. Such as discrimination? Absolutely. We have discrimination, we have censorship, we have racism. There are these things, and a lack of access to resources. Yeah, there's some people that are born into resources and assets and connections, and others that are not, or people that could afford certain things and others that can't. So addressing these issues is necessary in order to truly eradicate poverty and create an environment of abundance for all. Abundance is only going to happen when we have freedom, when we have responsibility, when there's consequence for our actions. What's really missing again here is compassion. People going back and healing traumas and focusing on mental health. When I asked ChatGPT how to create wealth or the habits of the wealthy, well, they said, ChatGPT, the AI said, well, there are many ways to create wealth. Some common strategies include starting a business. Okay, it didn't mention that in eradicating poverty, so they're now making a distinction. There's a big difference between being wealthy and avoiding poverty. That's an important note for all of us to take into consideration. The second thing it said is investing in the stock market. Now, do you think the people investing in the stock market make the most money, or do you think the people that go public and issue an IPO make the most money? That's one thing to consider. And is everyone getting the same returns? Because in my research, the hedge funds are making a lot more than the average person that just buys, holds for the long term. It says to invest in real estate. Maybe or maybe not. It depends on your investor DNA. And saving and budgeting effectively. Saving, I agree. Budgeting, I disagree. Because if you automatically pay yourself first, set money aside, build up your savings, you don't have to go and budget if you're not overspending. Now, if you're overspending, I'm sorry. Bad news. You got to budget, and budgeting sucks. Well, look, investing in the stock market, how many stories have come out over years about people just absolutely taking people's funds? I mean, obviously we know Madoff, and his last name was Madoff. He made off with money. We should have known. But people are like, no, he was in charge of the NASDAQ. Great. He got an appointed position so that he could make everybody believe in something that wasn't true. So is there any movie that's good about Wall Street, by the way, that shows that as the place that you should trust? Wall Street, Wolf of Wall Street, Boiler Room, the list goes on. It's always a terrible situation where a few people get extraordinarily wealthy and the masses kind of get a little bit of money. So the next point that ChatGPT makes is saying creating wealth often requires hard work. Now, let's define hard work. Like, if you find something that you really enjoy, that you want to do the work on, you can work long hours, but often people think hard work as manual labor. People think of hard work as trading time for money. And when we get in this notion mentally that everything is hard and it's work, then it starts to become exhausting, and we do the things that we hate in order to live a life that we love one day, someday, that never comes. So I don't like how vague the word hard work is. I mean, we also could use the cliche where people say smart work. Well, yeah, that's better than hard work, because if we think about leverage and scale and more impact and reaching more people and leveraging technology, that could be a lot more effective than just working hard. I know people that work hard and don't make a lot of money because they don't have the right career, or it's not the right situation for who they are as a person. It also says creating wealth requires dedication and discipline. I would agree with those, as well as the ability to identify and capitalize on opportunities. And yeah, a lot of people have a hard time capitalizing on opportunities. Instead, most people get caught up in distractions. They think something's going to be great, so they start chasing it. They get excited about it because they hear about people making money in it. This happened in the gold rush way back in the day. It happened in the gold rush of the crypto era not too long ago. And it starts to sway us into things where we're chasing dollars without a philosophy, without a premise, and without a career, in hopes that we're just going to be like a lottery ticket winner, right? Like it's our lottery that we're going to get that. But the thing is, the people I know that crushed it in Bitcoin were nerds for that type of thing long ago. And then everybody else came in way late because it was part of the culture. It was part of social media. They felt bad about it. They didn't know anything about it. And then they just went and jumped in. And then they found out a lot of that was pump and dump. It was shit coins that had no development teams, or, it wasn't sustainable because there wasn't a lot of knowing whether what the story was true or not. So look, it also says ChatGPT to create wealth can also involve taking calculated risks. Calculated risks, like I want to focus more on the calculated side than the risk side. Like calculated risk management. Like what looks risky to one person because you don't understand how they're doing it might be the sole purpose of another. And what is touted as risk might not have been that risky at all because they saw a market opportunity, knew how to capitalize on it, had the right relationships, which I call relationship capital, and the right knowledge around that. So I think that we've overemphasized risk, and we like to tell these stories of someone that risked it all and made it, but we don't hear as much about the stories where someone risked it all and lost it all, which is the majority of the time. So I think wealthy people are actually better at mitigating risk. Ray Dalio, who wrote the book, Principles, talks about how much he focuses on risk management. That's what makes him one of the best investors of all time. Yet most people are going, look at this person that risked it all and they made it big. You know what? Sometimes those people end up losing it big as well, but we've already moved on and we're on to the next story. So don't be seduced by that. They also say they're willing to persevere through challenges and setbacks. Here's what makes someone wealthy move beyond challenges and setbacks is vision. Vision is this magnet that can move us forward. Vision is this thing that gives us purpose so that the minutia doesn't drain us. See, if your problems are bigger than your vision, you won't make it past challenges and setbacks. But if your vision is big enough, like, man, I got my ass kicked in 2008, but you know what? I had a big enough vision that I got through that landmine of real estate meltdowns. I learned the lesson, ask better questions. I got up earlier and did a little bit more work during that time, so I was resilient because I thought the message I had was important enough, and the career that I had was compelling enough, and the work that I was doing was connected enough to who I was as a person that it spoke to my sole purpose. But you know what? If I was a full-time real estate investor and that was my entire life, I might not have made it through that challenge or setback. But I knew that other people suffered with, chasing returns, and I knew people didn't know about 9 financial myths, and I knew that people were struggling at saving tax and being more efficient with their money, and that they were hating budgeting. And so I am passionate about that topic, which helps me to persevere. So ChatGPT said, ultimately, the specific strategies and approaches that work best for creating wealth will depend on an individual's goals. No shit. But still, beyond goals, it's about vision. Goals are just stepping stones to a vision. If you have the wrong vision, you're in the wrong container. It's not going to be compelling enough to move you forward. It says that the individual's resources, your mental capital and your relationship capital, and how resourceful you're being willing to be. And it said circumstances. So maybe it's talking about Lucky Sperm Club. Did you inherit money? Or were you born in a third world country? Or were you born with major health challenges that require most of your time? Absolutely, that is one of the things. Like, everyone can be wealthy if wealth is an internal game. It's about joy, fulfillment, and happiness. Not everyone can be wealthy if it's an external game, depending on what country they're born in and if they can ever escape that, if it's filled with tyranny. If you were born in North Korea, the chances of you being wealthy have to do with the family you were born into. But at the same time, there's plenty of countries that wealth can be seen externally with the things that we acquire based upon where you're at. But most importantly, those things won't bring sustained happiness, especially if you're not happy with who you are. If those are masking the insecurities and frustrations you have, AI doesn't know about this emotional shit. It knows about the things that it's regurgitating based upon human error and mindset, that most of this has come from Wall Street or come from banks or come from people that are separating you from your money. Again, seem a little bit pissed off here, but it's just, I'm going to sleep better knowing that there's a long way for this to go. Here are a few habits that many wealthy individuals have in common. I asked that. I put, what are the top habits of the wealthy? And this is the final section of this. And it actually had some decent stuff it came up with, but again, I'm going to pick it apart. It said, here are the few habits that they have. Number 1, setting goals. Wealthy individuals often set clear, specific, and measurable goals for themselves, so that's using the SMART acronym here. This helps them to stay focused and motivated and enables them to track their progress. How they set goals, what type of goals they set. Again, it's missing. Vision is the container. Goals are the stepping stones to get that. So they have a vision to liberate 1 million people to become financially independent, to plant a seed of hope, connection, and expression in the hearts of 1 billion people. That's a vision. Then what are the goals that help you get there? No, wealthy people have a vision that's not already in existence. It's beyond what there's current capability for. That's beyond what we can even see as individuals. And vision is the rarest commodity. Goals are something almost everyone sets that I know. Maybe there's some that don't. So again, it's missing the mark that vision is the key. All right, number 2, saving and investing. Building wealth often requires saving and investing a portion of your income. The wealthiest people didn't save a portion of their income. It was they had a radical idea, or they built an extraordinary business, or they disrupted an entire avenue of how we lived before and created a new way of being, a new way of doing, right? So I don't think that, we think of the icons that were out there, what did we hear? Steve Jobs is just a great saver. He was really good with goals. Now, he said crazy shit that we actually saw other people build and bring to fruition. It wasn't even that he was a tactician or knew the technical aspects of it. So it says saving and investing, building wealth requires a portion of your income. Wealthy individuals tend to be disciplined about setting aside money for the future and investing it wisely. This is completely bass-ackwards. No. This gets you to think in the world of contributing, taking money and setting it aside versus investing in yourself. This gets you to think about giving your money to other people rather than funding your own dream. This is all about like being disciplined of saving a percentage of income versus being disruptive and changing the game. So this is not what the wealthiest people do. Like the middle class, that's upper middle class, that lives an okay life, yes, they do this, but this is a rule of the upper middle class at best, not the wealthy, which is unfortunately the place I see with most financial books. Number 3, continuous learning. I agree, but not learning just in classrooms. It says wealthy individuals are often lifelong learners who are always looking for ways to improve themselves and their businesses. Notice it says businesses when it talks about wealthy. They're open to new ideas and willing to learn from others. Yes, ask better questions, have a better life. Continue to learn, have a rookie mind at times to say, I don't want to act like I know everything because then I don't learn anymore. And what might I miss during that time? All right, number 4, it says networking. Building a strong network of contacts can be valuable for finding new opportunities and building your business. First off, it's looking at contacts instead of human beings. Networking sounds like this shit was written in the 80s. We're in 2023 for crying out loud. I'm talking about relationship capital. I'm talking about building connection with someone. I'm talking about, having catalysts in your lives. That's the deeper part of this. It says wealthy individuals often make an effort to cultivate. Make an effort to cultivate? Did a preschooler write this shit and maintain relationships with other successful people? Okay, thanks, Captain Obvious. What an amazing one. Number 5, staying healthy. Okay, I agree. Maintain a good physical and mental health is important for achieving success in any area of life. Yes, wealthy individuals often prioritize their health by exercising regularly, eating well, and taking care of their mental health. That'd be a good one. Manage their time effectively. Yes, wealthy individuals are often good at managing their time and prioritizing their tasks. Because if we understand ideas, it transcends time where we can get exponential results. That's me saying this, not AI. Yeah, if I'm terrible at managing time, it's going to be hard to get anything done, which means, wealthy people are really good at delegating. They're good at finding amazing talent. They're good at executing on ideas, but the right ideas and having a vision. These are things that were kind of missed out on part of this. What most retirement planners want you to think the rules of investing are, well, it isn't helpful. Sometimes it's actually destructive, and at best, it's going to limit you. If you follow their plan, well, then just count on too much volatility. Count on plenty of fees and a lot more stress than is required along the way. They're limited to how they get paid. And even the best of them, the best, nicest people you could imagine, they still have a problem. It's impossible for them to have your best interest at heart, considering they lose compensation if they do. I should know. I used to be one. Look, growing up at 19 years old, I became a Series 6 and 63 licensed financial planner, I guess. I mean, I ended up later getting my Series 63 and 5 and so that gets a registered investment advisor designation. But the reality was, you know what? I was just peddling mutual funds. And the studies have shown that if you're in robo-advisors, using technology and AI for that, or if you're in an index fund, after 10, 20 years, the chances of you being ahead of paying the high fees of like American funds and these other mutual funds, well, you're just paying for less money in the future. That's crazy, right? You're paying these managers, but their hands are tied to what the objectives of the funds are. If it's growth, they have to stay in growth, even if it's not time to be in growth. If it's fixed income, they can't invest when it's time for growth. So that's why a lot of more wealthy people move to hedge funds, which they have less, rigidity, and they can move to different types of things and even use options and stuff like that and hedge. So that's what's called hedge funds. So anyway, I think what's important is that we look at the limitations around what most people think when it comes to the rules of investing. I'm going to pick those apart. Then I'm going to give you my 10 rules for investing. This is going to be comprehensive. It's going to be very impactful for you to avoid the landmines and the mishaps and the misinformation and navigate this so you become a more informed investor. I know the reason I'm doing this is because you know how painful it was when I had all my family in mutual funds. I had them cash out their EE bonds and their certificates of deposit and money in cash and coffee cans. I'm like, be in the mutual funds. And in 1998 and 1999, I was a little financial Einstein. helping them make tons of money. Not because I was smart, because the market just went up a huge amount those 2 years. And then the year 2000, 2001, 2002, the market had double-digit losses. 10%, 20%, 30% type losses. So all those gains were wiped out so quickly. Good news was I went to all of them by May of 2000 and said, I don't know what the hell I'm doing. You should get your money out. So this is what I believed when I didn't know what the hell I was doing, which is probably what you heard. I'll give you the 10 philosophies you hear for most retirement planning. Number 1, start as early as possible. Time is one of the most important factors in investing. It allows your investments to compound over a longer period of time. So let me pick that apart. Yes, if you're just setting money aside in a retirement plan and investments that you're going to wait for 30 years, the earlier you go, the more opportunity you have for compounding. But what it's not considering is the compounded cost of fees, the compounded cost of volatility. If you have a loss 1 year, you lose that time value. So it's not helping you understand risk. We'll go over that a little bit more here. But what it's really neglecting is cash flow. My belief is create economic independence. I'll go into more detail with that because cash flow is going to beat compounding returns. And I'm going to give you the formula later on of how to create economic independence where your assets cover your basic expenses. And you can do that in 3, maybe 10 years, depending on, are you starting in a hole? Do you already have a good amount of assets? Or are you starting from scratch? It just depends on your level of commitment, but you don't have to wait 30 years for compound interest to work. The miracle for compound interest is that people buy into it and they wait for 30 years, sacrificing their life away while the banks use cash flow and the institutions make money on your money. And it's ultimately playing into their hands, not into yours. Now, I know it's heresy to say maybe compound interest isn't the best thing. I want you to go out there, interview people, talk to older people, look at your own life. Has compound interest served you well? I found more people thought it was going to be better than it was. Because imagine this. It doesn't matter whether you lose 10% in year 1 or year 30 because you're going to have the same impact. Because 10% in the first year, if you only invested $10,000, only a $1,000 loss. But that's $1,000 for the next 29 years. So that's a compounded cost. Or if you've grown that money all the way to 1.74 million 30 years from today on your 100 grand, but then you lose 10% in the last year, that's a lot of money. You know, we're talking about $174,000 in that last year that you're losing, actually more than that because you didn't earn 10% and you lost 10. So either way, we have this major cost when we're just compounding and letting it be volatile and paying for all these fees along the way. It's neglecting cash flow. And if you can create cash flow and create economic independence, rather than saving 10% of your income and then waiting for 30 years, you can have 100% of your income build more assets because your assets cover your expenses. That's what economic independence is. So the way that most retirement planners and the world handles, investing, they'll say rule number 2, diversify your portfolio. You've heard that. Diversify, diversify, diversify. Don't pull all your eggs in one basket. You've heard that, right? Spread your investments across a variety of asset classes, such as stocks, bonds, and cash to reduce your overall risk of your portfolio. Diversification is diversification. It's admission of ignorance. I don't know what's going to work. Put something over here, something over there. Diversification is a tool when you're already wealthy so that you can have your portfolio be preserved, not as a growth strategy. Again, cash flow is key. Plugging financial leaks is going to outperform a diversified portfolio, which I'll give you resources that help show this and verify everything that I'm saying here. But this is something I believe focus is more powerful than diversification on the way up, but focus with risk management. I'll go into more detail later. Number 3, it says, develop a long-term investment strategy. Okay, this is what's a long-term investment strategy? They say, don't let short-term market fluctuations dictate your investment decisions. Yeah, they're saying, if the market goes down, just stay with it. You're in it for the long haul. You don't want to get out now because it's going to come back. Why? Because their compensation is tied to you staying invested. And when they tell you focus on your long-term financial goals and stick to your investment plan, that's often just speak or sales speak to say, just stick with it because if you don't, I'm not going to get paid. Most of investing is synonymous. It's like Kleenex, right? That's just a brand name for tissue, but we call it Kleenex. We call investing the stock market because it narrowly gets us to think about just setting our money into something we don't know enough about, we don't understand. And here's the problem with long-term strategy. Technology, artificial intelligence, this can completely disrupt companies and some of those might go bankrupt. And we didn't have that kind of a situation even a decade ago. So what happens if you're invested in 500 stocks and 100 of those become obsolete in the next 7 years. That's something to consider. We're playing in a different world and a different set of rules. Now, there's another one that says, this is the fourth biggest strategy most retirement planners will tell you, dollar cost average. Really? Who wants to be average? Is that why you're watching this right now? You want to be average? What dollar cost averaging says is just put money in every month, whether the market's going up or whether it's going down, you're going to buy at an average price, right? So it says it involves a fixed amount of money at regular intervals rather than trying to time the market by investing all at once. This can help you reduce the impact of market volatility on your investments. Okay, it can help you reduce the impact of volatility, and it also can help you miss out on opportunity and also have you neglect stewardship and just go, I'm just going to let this ride and hopefully it works out. And then from 2000 to 2002, my clients would have just lost for those entire 3 years, or 2008 to 2010. People lose for those entire 3 years. And it's all because of this mindlessness that they're trying to get us to think. When they say long-term, they're not talking about having a strategy. They're talking about just staying in it long-term. When they say dollar cost average, it's just set it and forget it and just put the money going, whether it's working or not. Would we do that in business? Would we do that in any other part of our life? Number 5, it says, don't try to beat the market. It's difficult, if not impossible, to consistently outperform the overall market. Instead of trying to pick winning stocks, consider investing in a low-cost index fund that tracks performance of a broad market index. I agree with that. You unfortunately hear that more from index proponents and not financial advisors, not retirement planners, because how do they get paid on an index fund? So if you're going to invest in the market, that is a pretty good rule. Remember, the 6th biggest thing that's said is don't let your emotions drive your investment decisions. Yeah, the higher the emotion, I'm here saying this, the lower your financial IQ. So that's good. I understand, but it says it can be tempting to sell when the market's down or to chase after the hottest investment trends. I also agree. People chase after hot investment trends and a lot of times don't know what's going on. They chase real estate at a time where there's low interest rate environments, but then they end up, when interest rates change or real estate goes down, they're stuck holding the bag because they waited too long. Or they get into crypto, not knowing what the coins they're getting into, how they work, just listening to some type of stories, and then they get in too late and it goes down. See, that's emotional decisions. And yes, that can lead to poor investment outcomes, but also just sticking in something that's not working doesn't make a lot of sense either. So when it says it's tempting to sell when the market's down, well, yeah, why not have a automatic situation where you do a trailing stop loss that if it goes down by more than what you're comfortable with, it automatically divests, and then you can regroup and be intentional with your investing versus automatic. I believe in automatically saving and intentionally investing in alignment with your investor DNA. This is one of the things that annoys me about retirement planning and wealth advisors. They say, be mindful of your risk tolerance. Risk tolerance is a stupid idea. It's a stupid notion. It says, how much risk can you tolerate? Well, guess what? If you're making money, everybody's super risk tolerant. Yeah, I'm not risk averse. I'm killing it. But when the market goes down by 30%, are you still risk tolerant? See, if I ask someone after the market goes down, tell me on a scale of 1 to 10 what your risk tolerance is, they want to punch me in the throat because you're not risk tolerant. You're simply thinking that risk equals return. So what investment advisors say is different investment options carry different levels of risk. Be sure to choose investments that are appropriate for your risk tolerance and financial goals. Well, when I went to school and I learned about investments, they would just showed me the charts that mutual funds and stocks outperform bonds, outperform money markets. So why not just go with the mutual funds? But what they're not talking about is when those companies go bankrupt, bondholders have a higher priority than stockholders. And what happens to the person's psyche and their ability to produce when their investments are suffering and all of a sudden they're drinking more, popping pills, because I've seen that happen on flights where the market goes down and people are super stressed and all of a sudden their life starts to suck. That risk tolerance just gets us to continue to buy into the philosophy of set it and forget it, wait for 30 years, don't spend your money, only live off the interest. This is benefiting the institutions more than you. Number 8, this is a decent review and rebalance your portfolio regularly. That's a decent strategy. As your financial circumstances or investment goals can change, you might want to adjust your portfolio. Be sure to review your investments regularly and make any unnecessary adjustments to ensure your portfolio is still aligned with your financial goals. Again, most financial people are only selling variable annuities or mutual funds or a stock and bond mix. They're not looking at other elements. They're not looking at other investments like a business or intellectual property or investing in your own skill sets and your ability to make more money or saving on tax. We're going to go through my solutions to all this, but 2 pieces of advice that they give, these again are pieces of advice like rebalancing and refocusing on strategy is advice you get that's helpful, but how good are the advisors at implementing if it's not automatically? Because again, it might be at odds with how they get paid if it's time to move to cash. Cash isn't something they get paid on. The 9th point, they say keep your investment costs low. High fees and expenses eat into your investment returns. So they're now talking about ETFs or looking at the costs of the administration of your 401k and stuff. So a little bit different than the expense ratio that we talked about before. I agree with that. Don't put all your savings into investments. It's important to have an emergency fund in case unexpected expenses or job loss. By the way, notice this is usually one of their later points. Consider keeping a portion of your savings in liquid, low-risk accounts such as high-yield savings accounts or short-term bond fund. I have a much better strategy than what they're saying here. But what's a more valuable, sustainable, and true model of wealth? I want to give you my 10 rules. Right? I want to give you something that is radically different than this very limited model that hasn't produced great results. And when I say it hasn't produced great results, 95% of people are not financially independent at age 65 because they're taught that model, which never looks at cash flow, which is always about just waiting longer, taking risk, hoping for the best, and then minimizing the risk with diversification, which starts to impact the return and gets you spread a little bit thin. Like, I'm very frustrated with what's out there. So this is my solution. These are the 10 rules for investing. Number 1, know your investor DNA. I don't love investing in real estate unless it's real estate that I'm living in or utilizing, like a music studio or a cabin. Like, that's not really what my gig is, but I know other people that are great at real estate and they actually love it. They like looking at spreadsheets. They like talking to bankers and property managers. They like going to properties and see how, if it's the right property. Like, there's people that like that. There's other people that are really good at acquiring businesses, other people that are good at creating intellectual property, other people that are good at tax liens, some people that are really good at commercial properties versus residential properties. There's so many things to invest in out there, but know your investor DNA and then stay in your lane. Focus, don't diversify. Learn to say no. There's going to be plenty of opportunity that comes to you, and maybe that investment isn't aligned with your investor DNA. If you say yes, it can become a distraction or derailment. That was real estate for me when I got involved in too many properties and had so much to manage. It was taking up half of my time and 90% of my energy. So just because it can make money doesn't mean that you should make money with it. Stick to your investor DNA and learn to say no. Here's the key to investor DNA. Invest in what you know. Your investor DNA is your values, which is your script for how to operate. It's your competencies. What do you know best so that you can learn about it? And it's your drivers. What interests you? What intrigues you? What are you driven to work towards? And then you focus on that, because risk is in you, the investor, and you can become a better investor by only doing what you do best and then avoiding the rest, which can become chaotic, require too much of your time, become overwhelming. This starts to simplify. Number 2, continually seek to become a better investor. Don't just look at, like, I'm going to hand my money over to someone because I think they're smart. Utilize them, but don't rely upon them. Seek to become a better investor. Invest in your skill set, your education, your knowledge around that. If you're in real estate, I hope you're still going to real estate seminars, that you're talking to your real estate friends and figuring out the best ways to navigate different economies and do different seller financing or seller options or Airbnb strategies or, different ways that would improve cash flow. So whatever you're investing in, like, my investments are books, so I'm taking courses on writing. I'm a speaker. I'm taking courses on speaking. I'm reading books on those aspects so I can do a better job at those things. I'm reading the comments when you guys say you interrupt too much when you're interviewing someone. So I've been working on listening. Thank you for your feedback here on YouTube. Some people say I talk too fast. Well, fuck yourself. No, just kidding. That's who I am, and I'm passionate about this kind of stuff. So I do read those comments and do appreciate them. I've actually had comments that I've completely changed a video based upon the comments because they were good points. I just recorded an audiobook because they had only put up an interview because I saw some of the comments. So I thought this was a book and it's just an interview series. So I did the audiobook specifically to address it. I want to add more value in your life. Number 3, I've said it before, but I'm going to reemphasize it. Focus rather than diversify, but protect your downside. Utilize your investor DNA, add collateral or guarantees where available. For example, if you're investing in a business, maybe they can do a UCC filing, which creates collateral with their cash flow. Or maybe you can file a lien on a property or have a position on a property if you're lending money. Or maybe it's, like a trust deed that way, or maybe there's certain insurances you can have. But look at ways that you can manage and mitigate that risk when you focus and have enough liquidity and savings in addition to that so that you can handle turmoil or economic changes along the way. All right, number 4. And this is a radical shift from what you heard on the first 10 points with traditional finance. Make money on the buy. What does that mean? Well, maybe you look for a distressed situation where you can offload something for them so they're not stuck with something they're hemorrhaging in real estate, and they're like, thank you. But you know what to do with that real estate. You know what to fix up before you flip that. You already have a list of renters that want that. You know which rooms you can improve that would increase your rents or ways you can add value. So look for distressed situations. It could just be economic turmoil where you're buying a business before it goes out of business, and now you have that customer database that might support what your knowledge is. You know, this could happen in simply people overreacting. I know people that were in the, that are pilots that bought a lot of stock during COVID, and they've made a lot of money because they saw there was an overreaction in the market because that's their area of expertise. So utilize ways to add value that could increase cash flow when it comes to real estate or when it comes to a business. These are all ways that you can make money on the buy, because if you bring unique knowledge in that acquisition that they're missing, or you have a strategic relationship that can partner with it, it automatically starts to create that additional cash flow. And anytime you invest and you can cash flow from day one, that means you've made money on the buy. Okay? Now, if you want to know how to make money on the buy and you want more detail on it, you're going to follow a link down here. And I'm going to give you my financial freedom course at no charge that Wealth Factory owns. And then you can learn about our Wealth Builders Club if you want to have more of me one-on-one, where you can ask questions each and every month, that is extraordinarily affordable and with a plethora of resources. I like that word plethora because I just watched The Three Amigos and they use that word. So here you just get that little benefit there. But if you want more on Make Money on the Buy, there's 7 key ways and 3 additional supplemental ways. So 10 ways to make money on the buy. I covered just 1 or 2 of them there. Number 5, create economic independence first by focusing on cash flow. See, economic independence is cash flow that covers your basic expenses from entrepreneurial income or asset-based income, not from trading time for dollars. There's 5 levers to get there. The first one is to plug your leaks. Save on taxes, interest, investment fees, save on insurance structures that aren't done properly, and put that money back in your pocket. Then number 2, engineer wealth. What amount of money you need every single month? Let's reverse engineer and find out how we can create that so that you're now economically independent, which means you have more freedom in your life to choose what you do on a daily basis. Then accelerate investment income. Do you have stagnant, lazy assets, retirement plans, investments that don't kick off monthly cash flow? Let's turn that into monthly cash flow to help you get economically independent. Then the 4th point, or the 4th lever, is to scale. If you own a business, it means what can you do to tweak to add more revenue to that business? Invest in that business first before you invest outside of that business. Or if you're an entrepreneur working for someone, what things can you do that create upside potential? Because it's about expanding the money that you make, not just making money on your money. And then the 5th lever is to make it count. You are your greatest asset, not a stock, not a bond, not a piece of real estate. So where can you have relaxation, rejuvenation, and recreation that helps you to feel more alive, that helps you feel more enjoyment, not just waiting for one day, someday in retirement. Enjoy life along the way. All right, number 6. 6th point of the top 10 here. And we've covered quite a few things, by the way. I'll just give you a little bit of a recap. Know your investor DNA was number 1. Continually seek to become a better investor was number 2. Number 3, a little bit more controversial, focus rather than diversify and protect your downside. Number 4 was to make money on the buy. And number 5 was to create economic independence by focusing on cash flow first. All right, now we're on to number 6. Focus on efficiency first. Look, in What Would the Rockefellers Do, I talk about the impact efficiency has over increased return. It's staggering how much more efficiency can create with results rather than taking risk. So I'm going to let you just go into the show notes, and you're going to see you can download What Would the Rockefellers Do on me. No charge. It's my gift to you. And you can go to the later chapter and see when I show with software. And we have these different models there so you can see with the impact of efficiency. And this is what efficiency is the 4 I's. The IRS. That's for all you Americans, but anyone with a tax agency. Number 2, interest. Number 3, investment. And number 4, insurance. Stay tuned to the end of the video. We'll connect you to other videos that talk about how to do just that, because this is the overall philosophy here today. Number 7, look for arbitrage or arbitrage opportunities. This is how you think more like a bank. Like, here's an example of arbitrage. I have a friend, Eric. He knows how to find used RVs because he has a pretty amazing technology platform that integrates all these different automations, and they find used RVs for sale at certain prices. And then he automatically has a waiting list of people that are looking to buy, where he makes a profit because him doing it He has a system that gets it quick. He's got the money to pick them up, and then there's already buyers, so he can immediately make a profit, and the person buying can find the RV they want at a better price. So it's a win-win, but because he has that technology and knowledge, he knows how to create arbitrage. He buys them from one main area that most people never think to buy them from, and then brings them to the United States and has all these people that he's selling them to. That is arbitrage. Or people used to do arbitrage with foreign currency because some currency was pegged. And so you could say, oh, I'm going to trade the US dollar for a euro, and then I'm going to turn around and change that euro for a peso. And there was an inefficiency or arbitrage by just doing those trades, and people could make money on that all day by just making the different trade. That's another example of arbitrage. Or banks use arbitrage all the time. They rent money from you. They might give you $1 for the money, and then they turn around and rent that out for $3 to someone else on this, and it's the same money. It's your money. That's arbitrage. There's tax arbitrage, where you spend $1, you get more than $1 back. That's arbitrage. So where are there inefficiencies in the marketplace that you can capitalize on that allow you to make money on other people's money, for example, or keep more of the money that you have? That's a pretty big one. Number 8, know your exit strategy. If you're going to invest, how you get to your money. Retirement plans are so easy to put money into, especially if you're an employee. It just automatically comes out. But when do you get a benefit from that? How do you get the money from it? You have to pay tax when you pull that out, or is it a Roth? If it's not a Roth, you have to pay tax. What's that going to feel like? So maybe you're investing in something that there's a crazy market. It's really volatile out there, and you're like, yeah, there's a short-term opportunity. But if you have an exit strategy, you capitalize on that return. If you don't have an exit strategy, maybe all that goes away, right? Number 9, invest in yourself. This is the key. Invest in yourself. Expose skill sets. Increase your knowledge. You know, I want to learn how to be a better writer. I want to be better on video. I want to be a better interviewer, a better performer when I'm on stage, whether it's comedy or whether it's teaching about money. So I'm investing in those things. But invest in who you are that leads to a better life, that leads to better energy. I went and got acupuncture today. I had a foundation training session with my trainer. I'm getting a massage on Saturday. That's other ways you can invest in yourself through self-care, through your morning rituals, through the relationships you spend time with, so that you really, even writing that you do, but actually spending money and investing money on ways to improve what you're doing. Hunter, who's editing for me, we're meeting with an editor tomorrow who has edited for Andrew Schultz. We're meeting with Marty Callner, who has edited who directed some of the biggest comedy specials in history, so that we can learn how to do a better job at bringing his skill set to even another level. And I can understand how to be a better performer for him, so that he doesn't have to cut out so much of me rubbing my nose or not telling enough stories or stuff like that, right? So yeah, this is the final one here is I want you to know how to manage and mitigate your risk, which means have a due diligence team. Like maybe you're small and you don't have a lot of money, so it's just one person, but don't make decisions in isolation, and don't make decisions of thinking they're in due diligence if they're selling you something and paid a commission. So the wealthiest people know how to manage and mitigate risk. So get this due diligence team, and I'm here to tell you, I'm going to hook you up with some true due diligence tools. I'm going to give you 10 questions. It isn't about, risk tolerance, like I've kind of beat up a little bit here, but really about risk management, to find out how aligned this investment is with you and your investor DNA, and how well you can apply the 10 principles or rules that I just shared with going about investing. So these 10 questions you rank on a scale of 0 to 5. 0 is just totally against, doesn't apply, you don't know. 5 is completely aligned, 100%, can't imagine it being any better. And what it does is it gives you a benchmark or a score to know what to move forward with or what to avoid. It also gives you questions that you might ask to help do better due diligence and assess whether the investment's right for you before you make that allocation. So it can either help you to avoid it, or it can help you to get more knowledge to see if you should go forward with it. So the first question is, to what degree is the investment aligned with your personal values? Now, there are investments probably completely against your values out there, and really not what you want to be allocating your money to, because I believe we vote with our dollars every single day. So what about, on the other hand, what if the investment's in total alignment with your passionately held beliefs? Like it really does something for you as far as like it's a cause you want to see in the world. It's an impact. It's a value. It's a product that you use or utilize, or investment that way. So you can rate how closely aligned it is on a scale of 0 to 5, 5 being something very much in alignment with your values that you're totally passionate about, and 0 entirely against your personal values. All right. So, and then the next question number 2 is Is the value created delivered to only a few individuals or to many? See, the fewer the people, the less the impact. Ideally, a good investment will have a positive impact on many people, not just a handful of individuals. Not just a handful of individuals. The more people who benefit from the value created, the more likely it is to be a healthy return. 0, few people. 5, a lot of people, right? Many, many people. All right, number 3, to what degree does it utilize your human life value? Ideally, an investment will utilize your human life value, which is all your ideas and knowledge and wisdom. It's who you are as a human being. It's your brain power. It's all of those factors, not your property value, the things you have, but you as an individual. So that could be your time, your expertise, or any of your abilities. If you have the ability to utilize your human life value, that's going to lower your risk. The higher the score, the better the situation. The lower the score, the less influence you have over the outcome. This is where people get into more of a gambling philosophy if it's a low score here around their investments, right? So 0, very little human life value or none, and 5, much opportunity to offer value with your expertise, time, and or knowledge. Number 4, to what level are you able to establish arbitrage? We talked about arbitrage as one of the principles. Arbitrage can be borrowing money to invest at a higher rate than the rate you paid for the loan. For example, if you borrow money at 3 and then invest to get 6, you've just created arbitrage. Banks do it every single day. Another way to create arbitrage is to borrow money to increase the rate at which you produce. For example, when a company goes public, it actually is creating arbitrage. The company is essentially borrowing other people's money by selling shares of their company stock, and the buyers of the stock, in essence, are lending their money because they believe that a particular company will be productive with it. If it were your company, then your goal would be to increase your company's production with the borrowed money. Your hope is that your ability to produce with that money is greater than what you're committing to as a dividend or a payout to shareholders. That's arbitrage. So for your investments, is it only your capital involved, or are you leveraging other people's money to earn a higher rate of return? 0, no arbitrage, only your money. 5, very high levels of arbitrage while you're leveraging other people's money. Number 5, to what degree could you recover or recreate or manage the risk around lost principal if this investment starts to decline? A lot of people start to panic when investments decline, or they'll move to something else after it's a little bit too late. They have no knowledge or ability to recoup losses. If you have expertise in a particular industry or an investment and know how to invest effectively around that arena, the chances are you'll be more successful at recovering and recreating lost principal. Most people don't think about their own abilities to recoup losses when they invest. They think more about what a great opportunity they have in front of them. So think about it with people investing in a business, but then that business isn't doing well and they get to take that business over. If they have knowledge in that, that happens all the time with venture capitalists and even angel investors and things like that. So 0, you have little to no chance of recovery. 0, little to no chance of recovery. 5, full recovery. Okay, on to 6. How are you going to get out of the investment? This is the exit strategy question. This is a question that most people rarely ask when they invest. They're more worried about how to get into the game, not how to get out later. When you come into an investment opportunity, you should be looking to cover yourself and both sides. Ask yourself, what's my entrance and what's my exit? Also, how secure is the exit strategy you have planned for the investment? Like when I got involved in a ton of real estate, I didn't have a good exit strategy. That ended up costing cash flow. It became a very painful, difficult experience. Some businesses aren't very liquid either. Some investments are very liquid, but they're not very profitable. So we got to kind of have more than just this question, right? But will it be difficult to withdraw or utilize? Let's use an example of a 401k. Make a 7% contribution from your check. Your employer matches 4% if you're not a business owner. Your instant strategy would be pretty clean, super easy. Plus, you don't feel the money leaving because it just comes out of your check before you see it. So just on an entrance strategy alone, if that's the only thing we looked at, thumbs up, awesome. Now, when asking the exit strategy questions though, would it be difficult to withdraw or utilize? In most cases, it's extremely difficult to liquidate the money in your 401k should you need to access it quickly. There's a 10% penalty as one example, or maybe if you're already employed there, there's a rule that you can't get that out without maybe borrowing, and that's limited to how much you can borrow. So 0, no plan for exit. 5, you deeply understand how to withdraw and utilize the investment. Number 7, to what degree does the investment provide an opportunity for immediate cash flow? I've been talking about economic independence, cash flow investing versus accumulation investing. So some people just defer cash rewards for years and years and years, and they may never even see a profit. As it often is the case with the 401k, they never spend the money. It's just stuck there. Society's been taught and indoctrinated with this accumulation theory, and people have bought it hook, line, and sinker, and look where it's got them. Cash flow is usually a better indicator of how successful an investment is. When you have cash flow coming today, you're able to use that money to fund your sole purpose, to create economic independence, rather than just letting it sit idly accumulating or losing value over time. Also, it's better to have $3 million kicking off $300,000 in cash flow than $5 million kicking off $150,000 in cash flow. unless you know we're going to take that difference in that $2 million and capitalize it or buy a great asset. So this isn't really about net worth. It's about unlocking net worth and having that money come directly to you. 0, no cash flow. 5, steady income cash flow from now forward. Question number 8. How much control do you have over any of the characteristics generating the return from the investments? This is a little bit like human life value, but the difference is there's many factors when it comes to an investment, from the collateral that you're setting up, which is going to be coming up, to whether you're involved in the company, to the collateral. I'll be talking about that coming up, to whether you're involved in the company, or to whether or not you can have direct influence and voting and stuff like that. So investment returns are only as valuable as the ability of those involved with the investment to produce them. If you don't have a clue on how an investment worked in the first place, then what do you think the chances are of being able to reproduce the same results if the market changes? If you have no impact upon the characteristics of the investment, let's say, for example, you have a hard money lending fund. You do bridge financing for real estate investors, and then they go and secure long-term financing. If you're in that game and you can say no to people or yes to people, you have a lot of control. If you're putting it into a fund and you have no control over what happens in that, that's an example of this difference. So if you have no impact upon the characteristics of the investment and how those returns can be manipulated or recreated, you probably don't have the right to be playing in it, or at least you're not going to score as high on this question. So 0, no control. 5, maximum control. Number 9, to what degree is it secured with liquid collateral? Now, I use liquid. We've seen this in the past where banks were, not that liquid because they had all this real estate collateral. They didn't know what to do with it. So if you're not good at real estate, that might not be good collateral. If it's a water right you know nothing about, that might not be good collateral. If it's if it's attached to a business or something like that, do you have a way to create any level of collateral or any way to protect the downside? Liquid means you could actually sell it and exchange it for form of cash. Now, this is a later question because not all investments are going to have collateral. The best is a lot of times a personal guarantee, because now you have full claim to the individual's their entire portfolio and assets unless they declare bankruptcy. So if it's not backed at all, it's a 0. If it's fully backed and you feel good about the collateral, that could be a 5. Now, the final question is, to what degree is the investment dependent upon the continuation of current market conditions? You can take opportunities that come up within current market conditions and go, oh, this is awesome, do really well with them. But are they going to last? So you have to realistically analyze what the current market trends are and how dependent your investment return is upon that market trend. If we look at 2020, even 2021, 2022, for part of the year, man, real estate just was skyrocketing, which was kind of crazy with COVID happening, but it did happen. And then interest rates started to increase and that really started to slow down. So did you understand those trends and when to make a change? See, if the trend stops, how does that affect your investment? In some cases, you may be completely dependent upon a current market condition continuing, like we saw in a lot of cryptocurrency. And still, you need to make sure if you're going to do that, you have a good exit strategy. So that was a question before. If you have a good exit strategy and then you're really thinking about when this is going to happen, and then when you're going to get out of it, it goes against all that philosophy I talked about with most retirement planners of set it, forget it, wait till you're 65, don't try to time the market, just wait. If you're totally dependent on the continuation of current market conditions, that's a 0. If you're not affected by the change in the market conditions, that's a 5. And you can score low here and have higher scores on everything else. So as long as you have an exit strategy, when you're going to get out, it may still make sense to move forward with this. Now, if you go to wealthfactory.com/scorecard, you can download these questions yourself, which will help you to apply all of the 10 concepts and rules that I shared with you around investing, and I help debunk the myths and misinformation around the 10 rules that most retirement planners and financial institutions will tell you about. So now you know better what to avoid, what to embrace. This comes down to you taking personal responsibility and being in charge of your prosperity. Should you invest or pay off debt? Look, the gurus have it wrong. The talking heads don't know your situation and what's best for you. And look, if you get this wrong, it will absolutely rob you of life enjoyment and wealth. There's absolute bias and a one-size-fits-all mentality for advice on investing versus paying off debt. Again, if you get it wrong, it will cost you. This may be one of the biggest culprits for bankruptcy, divorce, and for sure financial stress. The number one reason listed for divorce is money. In 2008 and again today, one of the biggest reasons for bankruptcy is being over-leveraged. If you watch Dave Ramsey and Susie Orman, they say you absolutely should pay off debt at all costs, ignoring economics, inflation, and this great wealth transfer that's happening right now. Or if you listen to Robert Kiyosaki or Grant Cardone, They say you absolutely should invest and leverage, use debt for acquisition, ignoring investor DNA, peace of mind, and risk management. So, who's right? This is the personal part of personal finance. I don't know why they call it personal finance, and most of the time it should be called transactional finance, and people don't treat it as personal at all. But it really comes down to 5 factors and one simple equation. See, banks are in the business of leverage and debt. Anyone who thinks they don't have time to manage the money, well, they may want to consider paying off debt, but to know for sure, let's dive into these 5 factors. The first factor is what I would call the peace of mind and economics factor. See, how do you feel and operate when you have loans? Does it keep you up at night? Does it create frustration and contention with your spouse or significant other? Is it something that you just absolutely, can't get over and you just wish that it was gone, and if it were, you'd feel like that weight is off your back? So you got to think, how does this impact your family or others with your financial choices that are impacted by those choices and decisions? And even think about things like the economics of an amortized loan that are close to being paid off. What do I mean by that? So say you have a 15-year mortgage and you're 11 years into it. You only have 4 years left, but that payment every single month has stayed the same, even though the balance has gone down, because that's what an amortized loan is. And maybe paying that off would free up way more cash flow than if you invested those dollars. So all this to be said, this comes down to personal preference, personal economics, and your specific situation. Part of what helps is something I would call your cost of money, also known as opportunity cost. Your cost of money is what can you get with your money when you invest it? What is that from a safe and more secure standpoint, net of all your costs and expenses? That's your cost of money. Or for others, cost of money is that really high interest rate you have on a loan that burdens you. Maybe it's this crazy number like 22% on a credit card, or even ones as high as 29%. That's crazy, right? It should be usury. But that's your cost of money, because anytime you don't pay down that loan, it's not just costing you $1 when you spend that money, it's costing you $1.22 or $1.29 depending on the interest rate. So cost of money is, if I pay cash for something, I forfeit the right to earn on that cash. And so what am I forfeiting? What interest could I earn? See, there's always an interest cost, whether we pay cash and forfeit the right to earn it, or whether we borrow it and then we pay for the right to use it. There's an interest cost all the time. So our cost of money is kind of the economics behind everything. What's your actual rate of return after your fees and after your taxes? That's your cost of money. Or what are you paying to borrow that money? But peace of mind, that's a lot more simple, yet even probably more important. Peace of mind is, if I'm in scarcity because I borrowed money, I'm over leveraged, and I think, well, this is the way that these gurus talk about, that peace of mind being decimated destroys my overall quality of life and becomes one of the factors that you really have to consider. So the first one is, what's the peace of mind for you and those you love? And what are the economic considerations? If you're almost to pay off a loan and you just keep making that monthly payment, well, what if you just took some funds, paid that off, and you freed up that cash flow? That's an economic consideration. Peace of mind consideration is, what do you feel like if that loan is paid off? See, Dave and Susie always think, oh, if you pay it off, you're always going to feel amazing. But you know what? I've had no mortgage before in my life. I've had a mortgage in my life. It really doesn't matter. And even to my wife, it doesn't matter. And right now, our mortgage is at 2.75%, where interest rates are north of 7%. So look, I've got pretty inexpensive money. But if my wife was like, I just can't sleep, I feel so frustrated that we have this mortgage, it feels risky, then I might want to consider paying it off. But because we both have this peace of mind having that, knowing that we have enough cash to pay it off, well, that peace of mind factor is checked off. So now it's economics. Can we do better than 2.75% with relative certainty? And the answer for us is yes. Well, that takes me to the second factor here, and this will help you answer that for yourself, is what is your investor DNA? Where would you invest the money if you have it versus paying off the debt? And does that investment create cash flow today? Because most people investments are locked away for 30 years in a retirement plan, and they don't know whether it's going to work out until they get way further down the road. And then the question with investor DNA is, which by the way, investor DNA is your values, it's your abilities or competencies when it comes to investing. It's the drive that you have and the interest you have in that, and maybe passion that's involved with it, and it's focus. So some people are better investors when it comes to real estate than others. Others are good at acquiring businesses. Some are maybe good at the stock market, most aren't. Maybe some are really good with tax liens or with cryptocurrencies. I mean, it really depends on where you're investing and what type of investor you are, and understanding your investor DNA. Hey, I know I'm interrupting, but it's because if you go to garrettgunderson.com/quiz, you can figure out your money persona. When you know your money persona, you'll be able to make better choices when it comes to your finances, understand where you've made mistakes and missteps and what was the psychology behind that, and really improve how you view money and how you work with other people with different money personas. So garrettgunderson.com/quiz, no charge, discover your results, and go ahead and comment and let us know what it was. And for some people, volatility with investments drive them crazy. It infringes upon that peace of mind that I talked about before. So what return can you sustainably get? What's your investor DNA? How can you become a better investor? And if you have uncertainty with that investing, or you have frustration around if it doesn't quite work out, well, that takes me to the third category, which is risk management. So the first thing is, what are the economics behind this and the peace of mind? For someone that's trying to put money in a retirement plan and they hope with their fingers crossed they might get 10%, yet have a 15% interest rate credit card, the economics doesn't make sense. Pay off that credit card. It'll improve your credit score, which could help you out overall. It'll probably increase your peace of mind. And ultimately, you're doing better by saving 15% than trying to earn 10%. So that's economics versus peace of mind. Second is investor DNA. For me, my investor DNA leads to building videos like this, writing books that I do, businesses that I'm involved in. That's my investor DNA. I'm not great at most real estate. I'm definitely not great with the stock market. So I'm not really invested in those areas. My interest rate, the only one I have is 2.75%. I can use something called cash flow banking, and I can get more than 2.75% with high degrees of certainty. So I still have that cash. I have access to that cash. I'm doing better, so I'm creating something called arbitrage, borrowing at 2.75 and maybe getting 4%. That is a positive return. But this comes down to risk management. What are your chances of success with your investments? If you're taking a lot of risk, you're going and buying shit coins, like Dogecoin or most cryptocurrency coins outside of Bitcoin or maybe even Ethereum, depending on your philosophy and belief in Web3. But there's so many different coins that are out there that were built upon hype with these ICOs. People are buying them thinking they just buy and hold and it was going to skyrocket and they're going to make so much money. Their greed gland kicked in and it wasn't an investment at all. It was completely gambling. So much of that happens within trading within the stock market. People buy options trading programs and click their mouse and hope that they're going to get these huge returns, 5% a month, and they find out they lose all that money. Risk management matters. See, if you were to lose with the investment, what impact would that have on your mindset, on your life, on your relationships? And have you thought with your investments how you can protect your downside? See, if you could earn the same interest rate as you're paying with a loan, well, maybe paying off that loan is the best thing to do because it's certain. You know you're saving that, where the investment might be uncertain. And that takes me to the fourth factor, which is your time management. See, how much time does it take to invest in real estate? When I had a lot of real estate properties, I had to talk to the property managers and the maintenance people, and I had to talk to the attorneys to set up the legal documents. I had to talk to the banks to set up the loans, and I had to go through all this process of gathering my taxes and managing my credit score, and I was doing things I didn't really enjoy, and it took a lot of my time, which had an opportunity cost from doing the things that I did enjoy and the things that I wanted to spend my time doing, but I was so caught up in investing that I wasn't managing my time effectively. So how much enjoyment do you have with the investments that you're making? See, paying something off just frees up that time. Investing requires stewardship, and is it worth your time? So what other things can you do with your time? So as we're considering, should you pay off debt or invest? It comes down to what type of investor are you? What is your investor DNA? What return could you earn versus what do you save when you pay something off? What peace of mind factors do you have? What kind of risks are you facing? And finally, before we get to the solution, the equation that's going to answer it for you, one of the things that is an argument towards borrowing or leaving your loans out there is inflation. See, inflation hurts with most things, but it actually helps with debt. The payment just feels like less of a burden year by year. If inflation is there, and we're like, oh, in 1980, $1 in 1980 acts like $3.70 today, well, guess what? That just means that a loan that you've had for 10, 20, 30 years, each and every year, that feels like less of a burden, less of a loan, less money because there's more money in circulation or more money that's been printed. So leverage in those situations, like can help you acquire assets, and it helps you have that inflation may push the values of real estate up over time, and leverage by borrowing to get that property might give you a lot of opportunity for growth and equity, but it can also increase your risk. Leverage is a scary word for most people because if we leverage our money by borrowing without the knowledge behind it, we gamble. And that gamble can end up being something that leads to bankruptcy, something that leads to a loan that you have to make a payment on, even though the asset isn't worth as much. We saw that in 2008. People had so much high appreciating property and everybody starts to, get in at the wrong time because the wealthiest people go, well, when everybody's in panic, that's the time I'm going to acquire. And when everybody's in greed, that's the time I'm going to sit on the sidelines. Yet there's a collective consciousness where people get so excited, I got to do it because I'm missing out. I got to get into the crypto now. I got to get into real estate because all it is doing is going up. And then all of a sudden it starts to go down. And if you borrowed to get into that, that can be a major burden with crippling consequences. Here's the solution, is to understand two things, your indexes. One is your investment index and the other is your cash flow index. Let's begin with your cash flow index. If you're borrowing money, if you have any loan, I want you to look at your cash flow index, which is take as your loan amount and divide it by your monthly payment. So your loan balance divided by a monthly payment creates your cash flow index. If it's a number less than 50, you have a very inefficient cash flow index. If it's higher than 100, you have a very efficient cash flow index. If it's between 50 and 100, you're kind of in the consideration zone of should you restructure, refinance, or is it like that's where you really got to look at your investment index, which is the next thing I'll tell you about. But you want a really high number because what it means is you've borrowed money, but you don't have a very high payment or it's not really negative consequence on your cash flow. So longer term mortgages can be like this, but some people go, yeah, but what about the high interest that you pay on a mortgage of 30 years or interest only over your lifetime? But remember, we always pay interest, whether we borrow money and we pay for the right to keep that money, right, or to use that money, or whether we pay cash and we forfeit the right to earn interest. It comes down to what you can earn versus what you pay. Again, if those numbers are similar, maybe just pay it off and have the certainty. If you have arbitrage where you've borrowed at a much lower rate than what you're earning, you have to look at the time it takes. You got to look at the risks that are involved to understand who you are, to understand your situation here. So the investment index is when we make an allocation towards investing, what is the amount of money that we put in that investment over time divided by the monthly cash flow? Now, most people have no cash flow when it comes to retirement plan or when it comes to their mutual funds because they're just reinvesting, thinking that compounded interest is what's going to be their solution and their savior. But ultimately, I'm in the game of economic independence where you have enough cash flow from your assets to cover your expenses because now every active dollar you earn can build more assets. It's an unfair, amazing advantage. So your investment index, if it's a really high number, it means you're not getting much cash flow. Let's go back to look at the previous example. Cash flow index, when you are the bank, you want a loan number for the person that borrowed money because it means you have a lot of cash coming in relationship to your investment or the amount of money you put out. When you're utilizing funds from a bank, you want a high number, right? They want the low number, you want the high number because it means that you don't have a lot that you have to pay every month for the privilege of accessing that money. So it's the same when it's the investment index. You want a low number. You put some money in there, but you're creating a high amount of cash flow off of that, which creates a low number. Now, if you have a high number, it means you have not that much cash flow for the money that you've allocated. So when you look at your cash flow index, you want a high number. When you look at your investment index, you want a low number. It's what are you operating as? The investor or the borrower? That's the question. So what impact would paying off a loan have on your cash flow? If you have a low cash flow index, you might want to pay that off. What amount of cash flow could you create by investing? You want a low number on your investment index because it means you've got a pretty strong cash flow from the amount you've allocated. And the spread of what you're borrowing versus what you're earning during high interest rate environments might be more difficult. If you could borrow money at 1% and earn 2%, that's a 100% markup. But if you have to borrow money at 7% to try to earn 10%, that's only really a 30% markup. We might have to check my math on that, but you know what I'm saying there. So what I'm looking at here is these 5 factors are critically important. Peace of mind and economics. How do you feel about it? And what are the numbers? Number 2, your investor DNA. What kind of investor are you and how can you become a good investor? 3, how do you manage and mitigate your risk so it's more sustainable? 4, how much time does it take when you're making those investments and what other things could you do with your time? And inflation starts to make that debt feel like less of a burden over time. So who's right? It comes down to you. Personal finance is very personal, and that's why we have this YouTube channel. Ask your questions. I like to answer it. Often I'll answer it in video form. But I think going to the lowest common denominator, if you always pay something off no matter what, that minimizes opportunity. On the other hand, always thinking that leverage is the answer. We've seen people like Rick Edelman, it's always have a mortgage, or Robert Kiyosaki, leverage debt. It depends on you, the person, in your investor DNA. So find out your cash flow index with your loans, compare it to your investment index with where you're putting money. And if those numbers are the same, well, then it's a choice. If you have one that's much higher than the other, then the choice is clear. If you have a very high investment index and a low cash flow index, pay off the loan. If you have a very high cash flow index and low investment index, continue to be an investor, but take into consideration risk, take into consideration the amount of time that you put into this, and ultimately what opportunities are out there for you. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.